My name is Jake, welcome to the channel. In today's video, we're going to do a review my pie video where I review subscriber portfolios. I really enjoy this series. I've been doing it for about 5 years and I try to do it once a month here on the channel. These videos are very different than the other videos that I make here on YouTube, and I see these videos more as, a casual conversation. If you and I were sitting in a room together, we were talking about your dividend portfolio, talking about investing, these are really the things that I would say, and I try to take more of a common sense approach to investing in ways that, if you never learned about this stuff growing up, these are some of the things that I've learned along the way when I've been pursuing financial independence and, pursuing FIRE, financial independence, retire early. And if you know my story, I reached what's called barista FIRE at the age of 37 here last year. And yeah, it's been an incredible experience. And, there's been some ups and downs, and I've shared part of that experience here on YouTube. And I just try to, explain how it's been going and really just the good, the bad, and the ugly, and not sugarcoat anything. If you've been a longtime follower of my channel, I don't script anything. I don't try to make things appear better than they actually are. And I try to share what it's really, really like to retire off of dividends. And that's what I've really focused my channel on. And yeah, that's a little bit about me if you're new to the channel. So in today's Review My Pie, we're going to take a look at one question and 3 portfolios. The question here is going to be from a 40-year-old here in the United States, and then the first portfolio, a 40-year-old from the US, and then the second, a 24-year-old from the United Kingdom, from the UK, and then the third, a 55-year-old from the US. And as always, everybody, I'll have the timestamps in the description below, as well as the portfolio links. And as always, everybody, please don't take what I'm saying as financial advice. It's just merely for your entertainment. And I don't review the portfolios in advance. I don't look at them. So everything that I'm reviewing here as I'm recording, I'm reviewing it live, and I try to keep it more of a, conversation versus preparing what I'm actually going to say when looking at these portfolios. And as you'll notice in these Review My Pies, I have everything from, 20-year-olds, 50-year-olds, 60-year-olds. There's a wide range of age groups and different goals and time horizons in these Review My Pies. If your time horizon is not in this video, I'm sure that I've covered your time horizon or your age group in a different Review My Pie video. A lot of people here that follow my channel are trying to retire early or live off of their dividend portfolio, whether that be early at the age of 59 or the age of 30. It's all subjective. It all depends on you. But regardless of what time horizon you're in, it's so important that you have a plan. And if you're trying to retire early off of dividends without a plan, hoping that things will just work out, sometimes it may just work out and sometimes it won't. But when it does work out, it could look a little like this.
Huh, I guess this one's broken. Come on, Rusty, let's go home.
Gosh. Oh man, true story. When I was back in my early 20s, I used to watch Family Guy all the time. And I guess I just shaped my personality around Family Guy. And it was so hard dating in my early 20s because I was so immature, and I would always have like these Family Guy references. And whenever I go on a date, either the girl would understand it or she wouldn't. And it was so difficult because back then, people just, I don't know, maybe it's the same today. Girls didn't always have a sense of humor, and it was so hard for me to find somebody that would share my quirky sense of humor. Now, obviously, I'm not saying that all girls don't have a sense of humor, because I found one. My wife has an incredible sense of humor. She's hilarious sometimes. Sometimes she's funny. I'm funnier. But whenever I see clips from Family Guy, I always think about that in my 20s, when that's all I would watch was Family Guy. Well, obviously South Park as well, but I'm a millennial, right? So yeah, just whenever I see Family Guy, I always think of how hard it was dating in my 20s, because half of the stuff that I would say, like references, were from Family Guy. But anyways, let's take a look at the question here from Ranson. He writes, "Good evening. I recently came across your YouTube channel and I really enjoy your content. I wanted to know if you had a video on this topic. I believe that we are headed for a recession, and I currently have my entire portfolio sitting in SGov. This is a short-term treasury bond ETF. Due to opening a new broker link account through Fidelity at my workplace. I love the idea of dividend investing, but also have at least 20 years before I can touch my retirement account. I currently have $385,000 saved. There's a clear distinction between saved and invested. I hope that you catch that if you're watching this. Since I feel like the recession may be impending, I was considering investing a large portion into SPYI and reinvesting the yield every month for the next 20 years. Oh my gosh. Okay, I would be buying when the market is down and while rising, while I would probably have a large downturn. I would probably have a large drawdown if we do have a recession. I will be purchasing new shares at a discount through DRIP. I think the total return could be superior to putting it all into passive index funds or letting the drawdown occur and waiting for a recovery. Am I missing something, or is my logic reasonable? Not really. I also plan on putting a large position into SHD and possibly DGRO. I just want to find a way to get invested into the market while trying to capture portfolio gain during an economic downturn. Thank you for your content and for any response you might send to me, Ranson." Okay, so Ranson, there's a lot of great stuff in here, and there's a lot of questions, a lot of things that I would want to cover here. So first off, you have to understand how asset classes appreciate over time, or what their anticipated or expected appreciation should be, right? So a bond is going to appreciate at a much slower rate than an equity, right? And equities, like the stock market, is really great in, for example, in inflationary times, right? When inflation goes up, equities are one of the best places to invest, right? When inflation goes up, government bonds are one of the worst things that you can invest in when inflation goes up. When we have deflation, government bonds are a great place, right? They're a great hedge against deflation. Now, you have to ask the question, are we in a deflationary time period coming up, or in an inflationary time period? And the question, or the answer to that question, is you don't know. Your accountant doesn't know, your dentist doesn't know, I don't know, your dog doesn't know. No one knows. And the people on YouTube scaring you, making you think that there's a recession coming or that you need to sell everything, those people they don't know, okay? I'm not going to use any derogatory terms. They don't know, okay? So if we can accept the fact that no one truly knows what's going to happen, you need to put together a plan that you can stick with and that you can emotionally understand and not, emotionally FOMO, fear of missing out, or emotionally do something that's going to cause you to have a reaction that may actually end up hurting you in the long run. When I say hurt you, I mean buying high and selling low, or letting your emotions take control of you. Let me share this true story. I love using my dad as this example. My dad, he's done a lot of things right, a lot of things wrong. When his mom passed away during the right around the great financial crisis, my grandma, he received an inheritance, and that money that he received, he never invested. He's had it in a savings account in cash this entire time. And I asked him, well, why did you do it? And I pushed him. I was like, why? And he finally answered, because I was scared. Because I was scared. At the time, going back to 2010, every year, basically, except for a few years in 2018, 2022, et cetera, every year you could have said that the market was at all-time highs. Now, I'm not here saying that the market is going to go up indefinitely forever every single year. Yes, you're going to have corrections. Yes, you're going to have crashes. It's inevitable. That I can guarantee you, right? There will be corrections. But as the world, the US becomes more productive, innovative, and as they're pumping more money into the system, equity markets will go up. So over a 20-year time period, coming back to what I was saying with understanding asset classes, equities are going to give you the greatest chance of return over a 20-year time period. Okay? And if you accept the fact that no one knows what's going to happen, you really want to take an approach that you can stick with regardless of what the market does. And the way that you're looking at this is all wrong. If a market correction happens and you have 20 years, that is a gift. Every time the market goes down, that is a good thing for you, right? For everybody in their 60s, 70s, they're living off of a limited amount of cash. That's not a good thing. But for somebody who has 20 years, you should look at it as a gift every time the market comes down. And it comes down to rewiring your brain. Okay, so that's on that piece. So really understanding asset classes over a 20-year time period, I could see a case with going 100%, stocks, equities, and if you're uncertain, you could go 100% into ETFs. Okay, now if you're maybe you're a little bit more risk averse, maybe you have 10% in bonds or 10% in cash waiting for that impending recession, right? So whatever it may be. But I would definitely take the emotions out of this and put together a plan. And the way that I take emotions out of it is I have an investing approach called the core and satellite. It's a very common approach. It's nothing that I created. Research the core and satellite. What it does is it takes away your emotions out of investing. It helps you to construct your portfolio. Okay. So that's really important. And when you say that you're going to invest into SPYI, you don't understand SPYI. SPYI is a cover call ETF, and cover call ETFs are not what you want if you have 20 years before you're planning on living off the income. They're inefficient. They're not tax efficient. In many cases, it depends on your situation and which account you're holding it in. And these are fairly new funds. Here on YouTube, they're praised. I don't like them. I'm very open that I do not. I'm indifferent. I don't really care. I don't have a dog in this fight. I just prefer the JP Morgan ones, like the JEPI and JEPQ over SPYI. I think these are overhyped on YouTube, and I think a lot of investors misunderstand these because the upside is limited. It is capped. And so if you have 20 years, your greatest asset is your time and the volatility that you're going to get. And the market growth potential is more important than a limited amount of income over the next 20 years. Okay, so you want to make sure that you're understanding that. If you have more than a couple of years, you don't want to invest in these cover call ETFs. And when I say couple of years, I mean when you plan on actually living off of the income. So don't look at dripping, dividend reinvesting into SPYI as superior to dripping dividend reinvestment into SEHD and DGRO over a 20-year time period. If I could bet the farm, I would bet that SEHD and DGRO are going to greatly outperform SPYI or JEPI or JEPQ or any cover call ETF. But the thing is, I don't know. People always talk about this, or they're now talking about this lost decade. Nobody knows. You know what's funny? This is what's so hilarious about all this. People have been talking about a quote unquote lost decade here the beginning of this year. The market's up 23% this year. Okay? And the people in the beginning of the year were pounding the drums. Oh, we're going to have a lost decade. We might, but imagine you sat in cash in January when everybody was saying that we're going to have a lost decade, and looking at the market, it's up 23%. How horrible that would feel. Okay. And that's why stop listening to all the noise and put together a plan, an approach that you can stick with, where you can leave emotions out and do some more research and understand what you're struggling with the most, Ranson, here is you're struggling with not understanding how to invest, right? You're getting a bunch of information online, and you're getting information from different pieces, kind of like here. This is another data point you're learning, but you need to make sure that you're continuing to understand the basics, the fundamentals of investing, right? Compound interest. You don't understand compound interest. If you're planning on investing for 20 years in SPYI, you don't understand what a covered call ETF is, and you don't understand compound interest. You need to understand those fundamental pieces before you go and put any money to work. Another tidbit here, make sure that you're focusing on time in the market and not timing the market, okay? And if you're dollar cost averaging over 20 years, I don't see what the big deal is. Like, throw your money in the market, whether now or in chunks over the next couple of months or years, and dollar cost average and enjoy the ride. And stop listening to CNBC and all these FOMO fearmongers here on YouTube. And I promise you, you'll live a better life. Speaking from experience. But yeah, thank you so much for sending over the question. I hope that helps and gives you some context, because I'm not going to tell you what to do. I'm just trying to tell you that your logic here is off, and you need to go back to the drawing board, and you need to understand compound rates, understand asset classes, understand time in the market versus timing the market, understand dollar cost averaging, understand covered call ETFs versus regular equity ETFs, bonds versus stocks. Like, there's a lot to, go back and make sure that you're understanding those things, and you'll be in a much better place. So thank you so much for sending over the question. All right, let's take a look at the first portfolio from Ryan. He writes, "Hi Jake, longtime follower. I've written you emails before." Yeah, I was actually checking. You've written me since I think 2021 or something. So thank you so much for following me for so long. That's awesome, man. I just wanted to have you take a look at my portfolio and give me some possible recommendations on percentages for each category and stock in each category. So when you say category, I'm assuming sector, probably sector. A little about myself. I'm 40 years old and looking to retire in about 20 to 22 years and want to live off dividends when I retire. I started slow and have been putting about $50 a week. You can decide whether you want to put this on YouTube, on the YouTube channel or not. Yeah, absolutely, man. I'll put it on the channel. Here we are. Okay, so a couple of things. First off, the first thing that you want to understand is if you're 40 years old and you already know or anticipate retiring after the age of 59 and a half, the first thing that you have to make sure that you're getting under control is where you're investing your money. Your 401k, 403b, your TSA, your Roth IRA, your individual IRAs. You want to make sure that you're first fully taking advantage, your HSAs, you want to make sure that you're fully taking advantage of your tax advantaged accounts. And then if there's money left over, then you put the money into a taxable brokerage account. Okay. So if you're not maxing out your 401k, you should be maxing out your 401k, because when you're 60 years old, you can always do a rollover or a conversion into an IRA, and then you can buy, dividend stocks. A lot of people, they feel like if they're going to retire after 60, they have to open up a brokerage account, because then they want to start investing into SHD or DJRO or any other dividend stocks. I wouldn't recommend that. Unless you're doing it directly into a IRA, but I would first max out your retirement account. So that's the very, very first thing. Okay. If somebody's in the same situation, if you know you're going to retire after the age of 59 and a half, make sure you're maxing out your retirement accounts. Now, the next thing, when it comes to the categories, I'm assuming you're talking about sectors and stocks. I follow a pretty simple guideline where if I'm investing only into individual stocks, I would not have more than 20% into a single sector, right? So no more than 20 or 25. I like to keep it around 20. No more than 20% in healthcare, discretionary, technology, utilities, etc. And no more than 5% in any given single stock of your overall portfolio. No more than 5%. Don't tell me you're Warren Buffett or that Warren Buffett does it, right? You're not Warren Buffett. Don't use him as a reference, because you're not him, right? So I always laugh when somebody says, Warren Buffett has so much in Bank of America and Apple. Well, that's cool, bro. Are you Warren Buffett? Oh, you're not? Oh, okay. Well, then maybe you shouldn't invest like him. All right. Okay. Right? Or you hear videos from like Mark Cuban or whatever, he says the diversification is for idiots. And it's just like, man, there's so much good and bad information out there. And I don't know. There's a lot of noise. You got to figure out what works for you. But what works for me when you're building a dividend portfolio, you want to diversify your risk. No more than 20% in a single sector, no more than 5% in a single stock. But here's the cool thing. If you invest into ETFs, that sector allocation doesn't really matter. Okay. If you follow the core and satellite and you have the overwhelming majority in ETFs, the 20% quote unquote guideline for sectors doesn't really matter because you're so exposed to ETFs that it doesn't really matter. All right, so looking at your portfolio here, you got 9 slices, 9 different sectors here. You got a decent dividend for a 20-year time horizon. 2.5% dividend yield is actually pretty good. I do like this. And okay, so I see here that there's a 0 expense ratio. So that means you only have individual stocks. Now, I'm going to greatly encourage you to consider including ETFs. Now, I know that it's not for everybody, right? But I would just beg you from personal experience. I'd beg you, if you've been following my channel for all this time, I beg you to look at ETFs. See how you can diversify and de-risk your portfolio by at least including some ETFs, right? What I try to say for the majority of people, between about 60 and 80% of your overall portfolio is in ETFs. Maybe if you're hell-bent on not having ETFs, maybe you have 10%. And then you gradually increase that or decrease it depending on your goals. But I would not recommend having just individual stocks unless you have a retirement account or a different account with ETFs. Now, this is the caveat there. If this is your only portfolio, I think you're doing it wrong. I think you need ETFs. If you have another portfolio like a 401k, and this is your Roth as an example, if your 401k is only into index funds, okay, this is completely fine. Okay, so I wanted to make sure that I included that there, but you didn't mention in your email if you have other accounts, but just I hope that makes sense. If you're a longtime subscriber, you know what I'm saying here. So overall, the asset allocation in terms of the sector allocation, not asset, the sector allocation is good, right? You got 20 in tech, you got 12 in staples, 14 consumer. Energy is pretty high. I probably would lower energy for a 20-year time horizon, because the beautiful thing about this is, you lower energy now, and then as you get closer to retirement, you kind of look at this like a target date fund. As you get closer to retirement, maybe you decrease tech and increase energy over time, right? Like you don't have to have this set up as if you were retiring tomorrow, because you're not. You have 20 years. So I would look at it that way and treat it kind of like a target date fund where the allocation adjusts every couple of years as you get closer to that date, your retirement. Okay. So, but all in all, other than that, I don't see any major red flags. It's just the energy. I like that communications is lower. Let's take a look at the healthcare slice. You got CVS, Johnson & Johnson, AbbVie, Pfizer, fairly equally weighted. Yes, let me see. You got 13%. Okay, I'm horrible at math. Let's pull up my calculator here. So you got 0.25 times 0.13. So you got about 3% in each individual holding in this slice. And like I said, I don't know if you have another portfolio, but 3% is good. The holdings in there, whether, these are a little bit higher, but you're not taking so much risk. You have 3% in them. That's really what I'm looking for. They're all blue chip companies, right? These are all established companies like Lockheed Martin, Waste Management, UPS, Caterpillar, all really great brands, great history of dividend growth and dividend payments, financials. Also, yeah, like this is a very conservative dividend portfolio. Very, very conservative so far. And then you got materials, international paper. Okay. I bought international paper back in 2020 when it was crashing. I think I had like a 7% or a 6.5-7% forward dividend yield on this one. I never end up keeping it, but I still remember international paper. I wouldn't have 5% in this company. For me personally, I would put this down to like 2%, and I would allocate this 2 or 3% somewhere else. I wouldn't have 5% in IP, in international paper. Communications, you got Comcast, Verizon and Disney. Okay, okay, okay. Yeah, and how many? What do you have in there? So you got like 1% of each. That's completely fine. Like this is not going to move the needle very much, and so I don't have any really strong opinions. What I have strong opinions on is over having 5% or having over 5% in a single stock or in a single sector or something like that. That I don't really have a strong opinion. Here you got okay, so energy, utility. Next energy is more of a utility, so that's why. But having 3% in these, I think, is fine. Okay, because you have 3 of them in there. You have next energy, which is so technically you only have about 7% in energy. Okay, let's see here. Consumer discretionary, Starbucks, Home Depot, McDonald's, Target, Lowe's. Like every single one of these companies are like America. Like you're investing into America, and these are well-established companies. I like Home Depot, I like Lowe's, I like Target, McDonald's. Like I don't think that you can go wrong with any of those. Tech, what do you have in tech? Okay, wait a second. 20%. Okay, you got too much in here. You got too much. Okay, so we found a spot here that I don't like. You got 8% in Microsoft and 8% in Nvidia. Now, who am I to say that this is wrong because Nvidia went up a lot? The stock went up. Okay, congratulations. What I'm trying to help you with is to diversify and to de-risk for the future. Now, something went up a lot. That's cool. What I'm trying to help you understand is when you reach retirement, you don't want to take unnecessary risk. And 5 years ago, 8% in Nvidia was probably an unnecessary risk. Now, hindsight 2020, obviously, a lot of people have what's called survival bias. Because the stock went up a lot, they think they made the right choice, which technically they did, but then they think that they can do it again and again and again and again, and then they're the next Warren Buffett. And that's where you run into troubles, is thinking that you can do this over and over again, where I argue and statistically the odds are just against you. So in my opinion, I would either add a few more technology companies in here that you like or decrease this percentage of the overall portfolio. That's in my opinion. What I think would even be better, in my opinion, is to decrease this and then add a slice for ETFs. And so you're even getting more diversification. And yeah, so that's just my opinion. But consumers, holy crap, how many? You got a ton of consumer staples in here. What do you have in here? You got 12%. You got like 1% in each consumer staple. It seems like this slice you know the most because these are consumer-facing brands. Maybe you take some of that technology slice and you put it in here, right? Maybe you take, if you don't go the ETF route, maybe you take 5 or so % out of tech and you put it into consumer staples, and that way per individual stock you're getting a little bit more exposure to each individual company, and then you feel more like you're an actual shareholder of the company. But that's just my opinion there. Well, Ryan, overall, I like the companies in your portfolio. There's a few where I think you're going a little bit too heavy and it's a little bit too risky for my blood. I wouldn't recommend it. You obviously are going to do what you're going to do. In terms of the percentages, we talked about that. I think, the next thing that you want to understand is, how does this overall portfolio, you have the average dividend yield of 2.5%. Have you run, the next step to this is running the weighted average dividend growth rate. So get an Excel or go on a website and calculate the weighted average dividend growth rate of every single company for your portfolio. And then what you want to do is you want to use a dividend reinvestment calculator, and then you can see how this portfolio is going to grow as you contribute more money over the next 20 years. That's the cool part, right? You got your portfolio now. Now the next thing that you want to take a look at is a dividend reinvestment calculator that will calculate your income over time. And I made a few videos on that. You can search on my channel, the dividend reinvestment calculator, and I walk you through that. But So that's I guess what I would say to your portfolio. I think you're on a great track. Then it just comes down to those three things. How do you stay out of consumer debt? How do you not spend more money than you're making? And how do you find new ways to make more money so that you can invest more money into your portfolio every single month? Because that's what's ultimately going to move the needle. How do you add another $100 a month and then another $100 so that you can build your wealth? But yeah, Ryan, thank you so much for sending over your portfolio. I hope that helps. All right, the next portfolio is from Jamie, who writes, "Hi Jake, my name is Jamie. I'm 24 years old. I live at home with my mother, but looking to move out with my girlfriend eventually. I am from the northwest of England, looking for some tips and criticism on my portfolio. I've attached a couple screenshots of my portfolio. They might take a second to render in when zooming into them. A bit of background on my financial position. So your current income, after tax, you make £1,625 per month working as an IT support technician. You have a saving pot, so you have $10,000 in a bonus savings account, which pays monthly. Okay, so you have a savings account with $10,000. You utilize Plum, which takes money out weekly. So Plum is probably like a Betterment or an Acorns or something here in the UK. Okay, and so you utilize that, and then those rounds up to, okay, so $500 in Plum. So, okay, so you got $10,500, and then total invested, you have in Trading 212, it's a brokerage account, you have just under £5,000, and you're adding 200 to 350 pounds per month into the portfolio. All right, that is awesome. So you're 24 years old, you're in IT, you're working in IT. This is good. Okay, so let's take a look at your pie, or how you have your portfolio set up. So you got, I guess, the sectors here. You got beverages or consumers, energy, ETFs, financials, healthcare, industrials, monthly dividend REITs. Okay, you got restaurants, and you got tech. Welcome to any feedback, and more than happy to provide further details. Kind regards, Jamie. Okay, so one thing that you're missing here is what percentage each sector represents, right? Like 34%, or like, say, for example, 50% Home Depot and 50% Costco is your consumer, but what percentage does consumer represent in your overall portfolio? So let me give you some tips on how to do this. What I would recommend you do is pull out Excel. Good old fashioned Excel. You can do Google Excel or whatever it is, spreadsheets. And what you're going to want to do is you're going to want to list every single stock that you have, or every single sector. It looks like you're basing this off of sector. So you're going to want to list all the sectors, and you're going to want to put a percentage. Okay, what is my target for each individual sector? Kind of like we saw in the last review. Well, exactly like we just saw in the last portfolio. You had like 20% in tech, 10% in energy. That's what you want to do, is you want to understand, okay, what percentage you want in each individual sector. And what you also want to do is what percentage of your overall portfolio is in ETFs. And what I would recommend you do is I'd have two columns. I'd have one column for where you're currently at, and I'd have a column for what your target is, what you're working towards. Because if you're not working towards a goal or a target, you're just going to kind of go through life, and you're not going to really end up anywhere that you maybe necessarily want to end up. You're just going to kind of drift through life. So you want to make sure that you have goals assigned to every single sector, every single group or investment, because that's what's going to get you to your goal. Now, I love analogies. If you follow the channel, you know I love analogies. If you just get into a car and drive, you're going to end up somewhere. But if you don't have a goal or a destination of where you're going, you're not going to end up where you ultimately really want to go. And here's the difficult thing. If you don't know what your goals are, well, that's where you kind of want to focus first is, well, why am I investing? Am I investing for growth? Am I investing for dividend growth? Like, what is the purpose of why I'm investing my hard-earned money? You don't want to just invest money because you think it's important. That's better than nothing, but you want to make sure that you have a goal behind why you're doing this. Okay, does that make sense? All right, so that's the very first thing. In terms of the companies, you got, I think this view is actually a little bit easier than looking at the screenshots. I'm just going to look at the companies that you have here. So you're 24 years old. You probably have a long-term time horizon. You probably have 20 years at least before you plan on fully retiring. That would be my assumption, 20 to 30 years, right? Between mid 40s, mid 50s would be my assumption is what you're probably working towards, right? So you got companies like Coca-Cola, PepsiCo, Starbucks. Okay, there's nothing wrong with those companies. They're good growers. They grow their dividends very well. Home Depot, Costco, great. National Grid, okay, some UK companies. I do like that you have ETFs in here. What I would recommend, and I say this all the time, when you're putting together your portfolio, I would encourage you to have the overwhelming majority allocated to ETFs, at least in the beginning, until you figure out what your ultimate goals are. Okay, unless you can tell me right now and here, like, hey, this is my goal, this is what I'm dead set on. Well, then yeah, then you can do it that way. But until you have your actual goals in place, I would encourage you or anyone to have an overweight your portfolio into ETFs. Okay, until you figure things out, right? And I say that because that's what I did wrong, guys. I didn't do that, and I regret it. That is why I talk about it so much. A lot of the stuff that I share here on YouTube is things that if I could go back in time, I would have done almost everything that I'm saying here. I wish I would have allocated my portfolio heavier into ETFs first because it would have had a lot less gotchas. Okay, and that's what I'm trying to help you avoid are those, gotcha, right? And before it's too late, right? So I'd much rather learn by somebody telling me than having to have the bad experience myself, but to each their own. So you got financials, you got MasterCard, okay, some low yields, high dividend growers, some healthcare, industrials, monthly REITs. Make sure that you're looking at how the REITs are taxed. If you're investing into US REITs, you will pay an international tax on those. So make sure that you understand that. It's the same thing here in the US. If I invest into British American Tobacco, for example, I pay no international tax. I pay like a ADR fee, but no international tax. But if I invest into UK real estate REITs, there is an international tax. Okay, so make sure that you understand that. Okay, and you got restaurants in here, you got tech. Okay, so yeah, I think you're off to a great start. You're not investing into penny stocks. You have a strategy, and what you're probably going to notice over the years is you're probably going to adjust your strategy, like I was talking about, because you probably don't have your end goal in mind. You don't have your destination in mind just yet while you're investing. So understand that you're probably going to change this up quite a bit, and that's okay. Okay, as your goals in life change, you're going to change your mind and you're going to change some things. But what I would recommend here is you're 24 years old. Okay, you're still very young. You're figuring out life. You're going to be moving in with your girlfriend soon. Your life is going to change quite a bit. And so you're not going to have as much time to review all of this. So try to make this as passive and automate as much as you can so that it doesn't become a burden. And a big way that you can do that is by overweighting into ETFs. And something that really helped me is construct your portfolio similar to the core and satellite, where you have a core portfolio of ETFs and you build upon your core with satellite positions, which can be ETFs or individual stocks, all that meet your goals. But yeah, I hope that's helpful. Thank you so much for sending over your portfolio. All right, the last portfolio is from Rex. He writes, "Hi Jake, my name is Rex. I'm 55 years old. I work for Union Pacific, so I have a pension and a 401k. I didn't start investing outside of my 401k until February of 2022, so I'm way behind. I invest in a Roth IRA, a taxable account, and I have an employee stock purchase program that I invest in with a match. Below is my spreadsheet I created and was wondering if you could give your thoughts." Well, Rex, thank you so much for reaching out. It's cool to see that you have a Roth IRA and you're investing in tax advantage accounts. That's something that you want to make sure that you're maximizing. You're not investing anything into a taxable account until you've maxed out your 401k and your Roth IRA. And then it sounds like you have a good ESPP, an employee stock purchasing program. So I think, yeah, taking advantage of that is a great idea. And the pension with UNP is actually really, really good. My dad worked on Union Pacific for many, many years. He got his pension. So I know that the Union Pacific pension is something that a lot of railroaders work towards. And there is that light at the end of the tunnel. So it sounds like you're really, really close to that. All right, well, let's take a look at your portfolio here. So the companies here over on the left, you have RS Capital, I believe this is a BDC. Then you got Blue Owl Capital, Union Pacific, Realty Income, Enterprise Product Partners, EPD. It's funny, you're a railroader, my dad's a railroader. He, one of his largest positions is EPD, EPD and Energy Transfer. And then you got the SPY and then you got SCHD. Okay, so you have a good range of different investments here. You got a BDC, you got Union Pacific, you got a REIT, you got a pipeline company, you got a covered call ETF, and you have SCHD, a dividend growth ETF. Now, I like this. What I would recommend you do is kind of similar to what I've been saying in the last portfolio, is put together a target of where you're working towards, right? You're probably going to work a couple more years. What I would recommend you do is put in another column here of what your target shares or target amount invested will be, right? This is where you're currently at. What are you working towards? What do you want your ultimate positions to be? How much do you want to have in Realty Income, EPD, SPY, SCHD once you retire? So then once you have that target and once you're working towards that, it'll make things a lot easier on you. And then you can calculate with, okay, what you're going to get in your pension and how much you're going to get in your income. And then it just comes down to what your expenses are. But all in all, I like your approach. I think, you're going towards a heavier or a higher starting yield. I think you could probably, maybe you look to add maybe a dividend ETF like a VYM or a DGRO to kind of add a little bit more growth, maybe just a small percentage, because, you could live another 20 or 30 years, right? So having a little bit more growth for the overall portfolio. And I guess the last thing that I would say with this is try not to go too heavy into some of these single stocks. When I talk to my dad, his largest position is EPD. He's continually trying to, or thinking about de-risking and selling a portion and spreading out his money, right? So not going too heavy in one or the other individual stock, I think would be wise, or at least something to consider. And, but yeah, that's just, or maybe what you could do is, instead of, if you didn't want to go more into ETFs, maybe you could add another high dividend stock or MLP or BDC and just kind of spread it out a little bit so you're not so concentrated. I guess that's what I would say. But yeah, all in all, I think you're doing a great job. What I would recommend as well is track the dividend growth, because you don't have a section in here or a tab for the dividend growth, because you want to understand how is that dividend, how is your income going to grow year over year in retirement. So that's important that you're tracking that as well. But yeah, Rex, thank you so much for sending over your portfolio. I hope that was helpful. And everybody, thank you so much for watching. I hope that you learned something new. I hope that it, gave you a different perspective into, how to look at your portfolio. And yeah, thank you so much for watching, and I'll see everybody in next week's video.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.